Hi, I'm Matt McAleer, President and Director of Private Wealth, joined by John Mousseau, CEO and Director of Fixed Income at Cumberland Advisors in Sarasota, Florida. Today we will be discussing our thoughts on the third quarter of 23 and how the action in both the equity and fixed income markets affected the Cumberland strategies over this period. Let's get started with our broad equity strategies, John. Our U.S. core remains tilted towards value, but similar to how you discuss barbells, we are barbelled value and growth. We did see value in third quarter start to respond a little more competitively versus growth. We'll see what we get going into this fourth quarter. One thing to note, in our U.S. core, we are tilted towards high cash flow industries and sectors. In terms of our international equity ETF strategy, we again are barbelled between developed markets and emerging markets. We're currently at about a 38% piece in emerging and a 62% piece in developed. We did see some pullback in the emerging markets this quarter. Most of that can be tracked to some of that strength in the dollar.
Right.
We've been discussing strength in the dollar can really cause headaches in global equity markets, global including domestic. It would be nice to see that correlation break. Strong dollar has been weak equity.
Absolutely.
Weak dollar, strong equity. See if we can get that balanced out a little bit. Our final core strategy is our active passive strategy, and this will lead into some thoughts from yourself, John. In the active passive strategy, it's balanced. It's a 60% equity, 40% fixed income strategy. The 60% equity is made up of approximately 2/3 S&P 500 and 1/3 mid-cap 400, and we do rebalance on weakness.
Right.
Had a solid quarter, ticked above benchmark mid-quarter, but then mid-caps weakened again. So struggled through September. What about on the fixed income side, John?
Fixed income, rough quarter, Matthew. And what you saw was a rise in intermediate and longer term yields. The 2-year Treasury bond barely moved, stayed around 5%.
Right.
What you had was the 10-year bond move up about, 65, 70 basis points to about a 460 yield. You had the 30-year bond now at a 470 yield. That was up about 80 basis points in the quarter. And a lot of that coming in September and the last part of August. And there were really no pure economic numbers driving it. What was driving it? A lot of it was fear of the Fed and what they came out. They didn't have a meeting in August. In September, they skipped raising short-term interest rates, but went out of their way to be pretty hawkish and say that short-term rates are going to stay high for a longer period of time. And what scared the market was the longer period of time, and the reaction was to take intermediate and longer term yields up to reflect that. Same thing in the Muni market. And what really caused the damage in the Muni market, which rose almost as much, if not more, than Treasuries, which is unusual because they're tax exempt, were underwriters just cutting deals to move them, and get them sold. So in the last 3 weeks of the quarter, you saw Muni yields move up significantly. Do we think this is an opportunity? Absolutely. So we incrementally move our durations out, buy some longer bonds. You're at a point now where you can buy a 5% tax-free bond. I don't have to do the math for the people at home to know what the taxable equivalent of that is. It's 8% to 9% for most people, depending on your tax situation in your state,
right,
and offers very compelling returns on a long-term basis, certainly on a risk-adjusted basis versus equity. So we are constructive from here, and I would say the biggest difference between now and last fall is the fact that trailing inflation is much lower than it was last fall,
right,
and interest rates are higher in Treasuries, not that much more higher in Munis than you were early last November, but inflation is down a lot. So if you look at it from that perspective, you've gone from a cheap market to a cheaper market.
Yeah, interesting point. Last fall is when we saw the peak in rates up until this period.
Right.
We saw a peak in rates at much higher inflation run rate.
Right.
If we're able to lock in 4.5s, 5s on the long end in munis, a good solid AA credit, and that inflation continues to drop, that's a heck of a spread, going forward, 1 year, 3 year, 5 year, where those coupons just continue to compound.
Absolutely. And we have one graph here basically showing three different lines on this graph. One is the 10-year bond yield going back. The other is the 10-year U.S. Treasury inflation index bond yield going back, the real yield. And the other is what we call the break-even inflation rate. It's the difference between the two, which is a market-derived forecast of inflation. And when you can see on this graph is that inflation indexed yield, the real yield, is now pretty much at what the inflation forecast is. That's just another way of saying that rates are now starting to bite. And you can see it in different parts of the economy. You see delinquencies on auto loans up a lot. You see used car lots and EV lots, lots of inventory there. Over-ordered, if you will, over-manufactured.
Sure.
You've started to see, other signs, credit card debt up a lot. So we think the economy is slowing down, certainly ratcheting down. Energy was higher this last few months, so that kind of pushed things up. But we think that is somewhat, only one part of the inflation number, which is actually down. So we're very constructive on bonds because they offer better value now than they did.
Okay, good thoughts. Over on the quant area of our equity strategies, remember these are mathematically driven, we got multiple buy signals in mid to late August and are actually long in that strategy. That also clicks over to our sector alpha strategy, which means when we are long on a buy signal, we are long the higher beta or aggressive sectors such as technology and consumer discretionary. The last couple notes I wanted to make are on our thematic strategies. The U.S. equity ETF, managed by David Kotak, focuses on trying to sniff out themes in the economy that can have long-lasting impact, whether it's in the energy area, whether it's in the technology area, whether it's in the defense and aeronautic area. During the quarter, we did pull back in that strategy and lighten up on healthcare and add to defense. Names such as Lockheed Martin and so forth make up that basket. We also hold a fairly large cash position versus where we are historically.
Right. We've been lugging that around for a little bit now.
And again, it's funny you said lug it around, John. We used to always say lug around cash when it was at 50 basis points.
Now it's cash is not trash.
Right. You're being paid a healthy 5% on your cash, so we're able to really wait to get a nice swing at something reasonable in here. Right. Similar in our tactical trend strategy. Keep in mind, in our tactical trend strategy, I manage that strategy. It is not a one asset class strategy. It's always going to have multiple asset classes. So U.S. equity and or international equity and or fixed income or commodities. In terms of that specific strategy, very strong quarter out of energy.
Right.
That was a nice holding. Wish we had more. You always want to have as much as you can of the good ones. The rest of the strategy really held in there very well, had no problem outperforming the benchmark in Q3. Where we saw a little weakness late in the quarter, which took a little bit of the juice off the performance, was some pullback in tech, Adobe, Microsoft, even Berkshire Hathaway, which is a large holding in the strategy. The last 3, 4, 5 days of the quarter started to fade a bit. But in terms of that strategy, also positioned with a cash piece in Treasuries in BIL, earning over 5%, really feel we're going to get some opportunity here in Q4 at some very reasonable levels.
You would think.
Yeah. So we'll continue to look to take advantage of pullbacks. In terms of our Q4, that's always the make or break quarter, John.
Yes, it is. And what we look for in bonds in the fourth quarter, particularly in munis, is we usually look for very good demand as you go into the end of the year, because December 1st and January 1st are two big coupon payments, maturing bonds, called bonds, etc. And there's usually a lot of reinvestment that comes back into the bond market. And you would think with yields at an elevated level, that demand would be pretty strong. One thing that I didn't mention is even with the backup in yields, and we did see these dealers cut deals to get them done, those deals were getting done with more like 10 to 15 or 18 times oversubscription on these deals. So there's plenty of demand for 5% muni yields.
Absolutely. We hope you enjoyed this video and look forward to providing you with more review content on the markets and on Cumberland Advisors investment strategies. We do this on a quarterly basis. Feel free to reach out with any questions and make sure to visit our YouTube channel, where you can find other relevant content such as our Week in Review series or strategy profiles. Thank you.